Hey guys, this is Spencer Powell and welcome back to Growth Mode, where we are all a work in progress. In this video, I want to show you why I love debt and also why you should too. All right, let's get into it. All right, guys, in this video, let's break down why I love debt so much and why I think you should too. Before we get to a couple of real examples, I want to talk about this concept just in general, because if you follow kind of the Dave Ramsey's of the world, then they will teach you and train you that all debt is bad. You should steer clear, get out of debt as fast as possible. And really, at the end of the day, that's not truthful advice. And I'm going to show you why. Now, consumer debt is typically bad debt and typically debt that you don't want to have. And I'm saying typically because it doesn't always apply to every single person. But typically something like a credit card and racking up 10 grand in credit card debt and then making these big interest payments every single month, that's bad debt. A car loan is typically bad debt. You're making interest payments that you don't have to be paying. Student loans, typically bad debt. Again, the premise there is that you invest in the education and then you will get some returns in terms of your income or your skills and whatever that will produce in the future. That's another video altogether. But generally, things that you take on as debt that don't produce anything for you can be kind of categorized as bad debt. Whereas good debt, you could see that as something that is enabling you to produce cash flow or greater returns, and it's actually moving you ahead. And so that is the kind of debt that I love. And I'm hoping after this video, you will love that debt too and try to get more and more of it. That being said, everything is personal. It's always a personal situation. Sometimes the math checks out. I could show you the math, but if just emotionally, like, I don't like having debt and you don't sleep well at night and it makes you uncomfortable, then you probably should follow that path. And there's still a way to move forward. But this path is going to show you basically how you can use debt to your advantage to move the ball forward. So let's dive in and look at two examples. We're going to look at one with buying a house, so buying an asset, and two is going to be buying a business, so a different type of asset. All right, so let's look at this first one. We'll say we're going to buy a $300,000 house, and I'm going to walk you through two examples. One, using this as purely an investment property, and then we'll walk through house hacking. So let's take that $300,000 house. And if you're buying it as an investment property, you're going to have to put 20% down. So that's going to be 60 grand plus some closing costs. We'll keep it simple for this example. And then you're going to take on a loan or a mortgage, and that is your debt. So if you're following Dave Ramsey and crew, they'll say debt is bad. This is a bad move. Now you've just added $240,000 of debt. Not good. I think this is fantastic as long as the numbers check out. So let's take a look. By doing this, you've basically fronted 60 grand. And now you've taken on some debt and you control an asset worth 300,000. So now you're going to make a payment on that. Based on these numbers and current interest rates that are pretty low, this will be an investor rate. You're going to be at about $1,350 a month. And assuming this is like a 3-bed, 2-bath house, pretty decent area, you should be able to rent this for, about $1,700. Again, this is just an example. Obviously, every market is going to be different. So let's say after, expenses and everything, that this is cash flowing about 400. So you're going to have a annual cash flow return of about 4,800 or 8%. So that is just your cash on cash return. So you took on this debt, but somebody else is actually paying it down. So over time, this 240 will go down as the renters pay off the debt. And then you've got this value of the home, which over time will appreciate, typically about 4% a year. So you put down 60 grand, somebody else is paying this down, this value is going up, and then you're also getting cash every year. So about 5 grand. So in about 12 years, just from a cash standpoint, you'll have recouped the 60 grand, but then you'll also have appreciated your 300 and then the loan will be paid down. So you'll build a bunch of equity. So see my other video where I kind of break down how that works and how real estate benefits you on all angles, but you'll see the numbers work out pretty favorably on that 60 grand that you put up. So that's one scenario. Good debt. If you are buying a house and then you're going to rent out some rooms, so that's called house hacking. You buy it, you live in it, and then you also, have some roommates, other people that are paying rent. So let's take the same $300,000 house. If you do that, you can buy a home using FHA loan. So only 3.5% as a down payment. So now you only need about 10.5 plus closing costs to get into the home. Your loan is going to be bigger, so you have more debt. This is even worse, right? No, it's not. It's awesome. So let's just say your payment is about $1,500, which is about what it'll be with interest rates. You took on more debt, so the payment's a little bit higher. But now you've got 3 bedrooms, so you could rent one of the rooms for $800. That means your cash flow is $800. And then every year you're getting $9,600 in rental income from that person that's renting the room from you. So because you put up less cash, you're actually going to almost recoup all of your cash in the first year. So you put way less down and you have more debt, but because interest rates are so low, your payment isn't that different. And then obviously we're renting one room here. If you have a 3-bedroom and you can rent 2 rooms for $800, so that'd be $1,600. So now your cash flow is $1,600. Then you're actually going to be making about 20 grand basically to live there. And so you're going to be living for free. So you can look at it one of 2 ways. You can say, hey, I've got this payment of $1,500 and now I've got all this 20 grand that I can go do something with. Or you can just say, hey, this covers, and I basically live for free, and then I'm going to go invest, part of whatever you're earning. It's all the same, just depends on how you want to look at it. So the house hacking example, this is something that can really put you ahead really quickly. This is what I did with my first townhome. It basically was like 2 bedrooms and there was a loft area. So I really only had 1 bedroom that I could rent out. But that covered more than half the mortgage. And I was able to just put all that away and then use that for saving up and getting into my next property. So again, you would look at this normally and say, gosh, this debt is really bad. But this debt is amazing debt because you put in $11,000 and basically all of your debt is being covered by renters. And so you're appreciating in value and you're paying down principal and you make your money back very, very quickly. So that is amazing debt. All right, so that is one example, and that is through real estate and buying a house. And you could apply this to buying an apartment building, a duplex, a triplex, any of those types of things. All right, so let's talk about buying a business. So this could be buying like a dry cleaner, a laundromat, or a service business, like a roofing business or anything like that. Let's say you wanted to buy a business and the business was selling for $500,000. So typically, if you're going to go and get like an SBA loan or something like that, they want you to put about 10% down and then you can get a loan on the rest of it. So if we did that, we'd have a $50,000 down payment and then $450,000 as our loan. So now we've just taken on almost $500,000 in debt. Now, depending on what the business looks like and all the numbers, there's a lot of factors here, but I just want to show this as an example. So if you took this loan and depending on your time frame, I think when I ran this was about a 10-year time frame. So you might have a monthly payment of $5,000 a month that you're having to pay just to cover the loan payments. That doesn't account for any of your business expenses. Typically, the way businesses are priced is it's a multiple of cash flow. So it could be anywhere from 1x to 10 or 20x cash flow if it's a tech company or whatever. But a lot of small businesses, service-based businesses, you're going to be looking at maybe 3 to 5x cash flow, maybe 1 to 2x cash flow, depending on how big the business is and how stable it is, and basically a lot of factors. But having said that, let's just say this was 5x cash flow. So you're actually paying probably at the top end of the range. So that means the cash flow every year for this business is $100,000. If our payment is $5,000, that means annually that is $60,000. So we just said, okay, I'm going to put down $50,000 and I'm going to take on all of this debt. And now I have a business and this business is running and I'm paying $60,000 just to service this debt and start paying down the loan. But it cash flows $100,000. So now I'm actually ahead the 100 minus the 60. So I've got 40,000 net positive that I'm basically gaining. And so after the first year, I've almost gained back my initial down payment, and then I've also paid down the loan. So over time, I'm paying down this loan. I'm also recouping all of my cash that I put into this deal, and then some. And then I can pay down the loan faster if I want, or I can go and use that to invest in something else. So again, when you use debt to buy an asset, it can be very, very good debt. Now, just buying any old asset isn't always going to be a winner. So you should always do your due diligence, whether you're buying a business or buying a property or whatever it is. But generally, debt used for assets is very good debt. Debt used for consumer goods and consumer things that don't produce income, don't appreciate in value, that is bad debt. So hopefully this gives you a good peek inside as to why I really, really love debt and how debt actually helps you build a lot of wealth in many, many cases. All right, guys, if you like this video, please hit the like button, subscribe to the channel, pass this along to a friend or somebody that might get some value out of it. Maybe they need to get into some good debt as well. All right, guys, see you next time.